If you have a bunch of cash sitting in a savings account, you are bleeding your wealth every single year. Inflation has been one of the hot topics, especially coming into this year. And people really don't understand what inflation is, what it truly means to your lifestyle and to your financial future. Well, in this video, we're going to talk about inflation because inflation's coming. What do you need to do? I'm Mel Abraham, and this is the Affluent Entrepreneur Show, and I look forward to seeing you in the episode. Hey there, welcome to this episode of the Affluent Entrepreneur Show. This one, we're going to talk about inflation. We're going to talk about that pesky parasite that could eat away your financial future. We're going to talk about what is it, what does it do, and what you can do to counteract it. I remember, for me, growing up, I was born in the 60s, early 60s, 61, and growing up in the 70s, I experienced the whole hyperinflation. It was anywhere between 12 and almost 15% during that time. I kind of experienced it through, because I was only like 10, 15 years old, so I was still in school. I experienced it through my dad's eyes. My dad constantly trying to cut coupons, and my dad looking at things and saying, oh my God, we can't afford to do this. I mean, it's going crazy at 15%. And I didn't really understand what inflation was. I just knew that, oh, okay, well, things cost more. All right. Well, that's what's happening now. And there's a lot of talk about, well, what do we do from an investment standpoint, from a wealth creation standpoint? What do we do? Where do we invest? How do we protect ourselves against inflation? And there's some things that they're talking about. Well, they say, well, cryptocurrencies are an inflation hedge. Well, I don't know. That remains to be seen. When we look at a market that's dropping, it seems to be dropping too. I mean, Bitcoin has gone from, as at the time of this filming, gone from like as high as 60,000 a coin to 34,000 a coin. So I don't know that it's a hedge, but that remains to be seen. We'll do another total episode on cryptos and things like that at some point. But let's just talk about inflation. What is it? Now I'm going to jump to my iPad because I want to draw some things out for those of you that are watching on YouTube. If you're just listening, I'll make sure that these graphics get into the show notes so you can make sure that you have them. But let's just play, and I'm going to simplify it, oversimplify it, just so you understand it at a fundamental level. I mean, there's all kinds of other things that go into it, but I'm going to oversimplify it for our work here. And that's this. It's a play against the supply of goods, the demand for the goods, the pricing of the goods, and the amount of dollars or the amount of currency in circulation. Okay, so when typically, I'm just going to go to the iPad. So typically you have a supply of goods. Okay, a company makes a bunch of stuff. They make iPhones, or they make buckets. They can, whatever it is, they make a set amount, and then we come along and we buy it. That's called demand. And what happens is supply and demand create this equilibrium in between, which is called price. So the transaction, the purchase, is at a price based upon the supply and demand. Here's what happens. When demand goes up or supply goes down, prices will go up. Okay? In other words, there's less to be able to buy, and there's more people buying, or they're happening at the same time, prices go up. When supply goes up, in other words, there's a ton of stuff on the market, or people stop buying, then prices go down. This is really a basic way of explaining it. But so this is what inflation does, that when prices go up, that's called inflation. That means that the dollar that I had today won't buy the same goods and services tomorrow. So here's the thing. This also has a psychological effect on what we do, because it becomes a self-fulfilling prophecy at some level. We've got a situation where we are hearing about inflation. Everyone's talking about inflation. Everyone's creating that fear around inflation. So what is happening psychologically? We're sitting back saying things are going to get more expensive. Things are going to get more expensive. Things are going to get more expensive. So what do? We go out and buy things now, because if we wait a day or 2 days or a week or a month, it's just going to get more expensive. What does that do? That by me accelerating my purchase decision because I'm fearful of prices going up, I'm increasing the demand against the same supply, and I'm self-perpetuating inflation. Prices are going up because I just increased demand out of the fear of prices going up. Now, that may not be necessarily what's happening right now, because we also think about some of the things that have gone on that have given rise, probably not the right word to use, but rise to this inflation, and that is this. We have had the pandemic, and in the pandemic, people lost their jobs. Then there was money put into the economy through stimulus. There was money put into the economy through the Federal Reserve. There was to allow that circulation to keep going. At the same time, we had supply chain issues. In other words, it was hard to get goods and services. I mean, you saw it. People panicked with the toilet paper at the very beginning. But getting certain goods and services has been hard. I live on the beach here in Laguna Beach, and I'm also on a board of a company that deals with the ports and logistics and everything. We've got 67 ships off the coast that we can't get in here into the port of LA and the port of Long Beach at this point to get them unloaded. Well, that creates a shrinking supply. So remember I said, if supply is restrained and demand is expanding, it increases prices, which creates the inflationary effects. That's what we're dealing with right now. Now, that doesn't mean that it isn't real, because it's real. We're living it. Prices of gas pumps, meat has gone up 10, 12%. All of that has happened on a regular basis. We've had inflation for a long time. It's just never been at this level. It's right around 6% right now. It's been historically between 2 and 3%. Well, what happens? What is inflation? I'm gonna jump to a couple of slides, let you just get a chance to see what has happened over the years with this. And so this is just inflation going from 2000 to 2021 and how it works. So if you look at it, a home in 2000 that cost $119,600 in 2021 cost $416,750, a 3.5 times, 350% increase. A car, $21,850 would be at $37,672, 1.7 times increase. Here's the interesting thing. Used cars are hard to come by. They're increasing even far greater, which usually it's depreciating. Gas, okay? $1.26. You remember $1.26? I remember when it was like 32 cents and then 76 cents, and my dad was freaking out. $2.87, 2.3 times in 2021. Listen, I drive an electric car, but my wife doesn't. In California, we'd be happy with $2.87. I don't know the last time we've seen that. All right. Bread, $1.26 to $2.12. Okay. Ground beef, $2.46 to $4.03. That's what inflation does. Let me show you a couple of graphs, because I think then it'll start to show you the importance of understanding this. Because what I want you to see is, remember I said at the very beginning, it's not about the number that matters. It's about what the number can buy you. If you are making $100,000, then the question is, will that $100,000 will buy you $100,000 worth of goods or services, products, whatever you want to do. In an inflationary environment, that $100,000 isn't going to buy you the same basket of goods. If you go in a grocery store, not that you're ever going to spend $100,000 in a grocery store, but let's say you spend $100 in a grocery store today. You get that shopping cart and you wheel it out, you put it in your car, and you're done. In an inflationary environment, you go in a month, 2 months, a year later, and you want to buy the same goods. You're going to take that same shopping cart, you're going to buy the exact same things. You can't get it for $100. It's going to cost you $105. Okay? And that would mean that there was 5% inflation from 100 to 105. And so what we need to understand, because this is where a lot of people say, well, I'm not sure, what does this do for me? What does it do to me? And so I want to just show you a couple of graphs that I created that'll show you what happens to your dollars when we do this. So if I look at this is inflation. This is at the historical rate of 3%. This is at the historical rate of 3%. Right now we're about 6%. Okay? If you look at the historical rate, if I have $1 today and I keep it for 30 years, that dollar that bought $1's worth of stuff in the store will only buy 41 cents worth of stuff. In other words, it lost 60% of its value. Okay? Well, what happens at the 6% that they're talking about now? Now, I don't think 6% is going to stick around at long term, but let's just look at it. Same dollar. Now, look where it is. At 6% over 30 years, it goes to 17 cents. So the same dollar will buy 17 cents worth of goods. In other words, it lost 83% of its value. Okay? Why does that matter from a wealth creation standpoint? Well, it matters because of this. If I look at, let's assume that I have $1 million in the bank today. Let's assume that I won the lottery, I put $1 million in the bank, and I think I'm set for life, and I don't have it invested properly. At 3%, that $1 million at 30 years is only going to be worth $400,000. In other words, that same $1 million will only buy $400,000 worth of goods. It loses 60%. So the other way to look at this is that if things are going up, how does this play out? Let's assume that I'm going to buy something for $100,000. Just going to use round numbers. Something that costs $100,000 today, in 30 years, if I wanted to buy that same house, certainly not in California for $100,000, but let's just humor me for a moment. Say that you're going to buy a house for $100,000. At 3%, that same house in 30 years is going to cost you $235,000. At 6%, that same $100,000 home is going to cost you $542,000. This is what we mean by the dollar isn't going to buy as much. It's about what the number can buy you. So, in other words, the $100,000 that you have today isn't going to be worth or as worth it from a purchasing power perspective tomorrow. So what do you do? What do you need to do to protect yourself? So there's a couple things that I think we can do to try to protect ourselves against the impacts of inflation. And we're going to be dealing with it. But at the same time, we can protect ourselves or reduce the impact of that. So I'm going to go back to the iPad so we can write a couple of these things down for you, and you can kind of work it from there. So the first thing is this, is that we always, one, follow the wealth priority ladder, okay? This is the way we allocate our cash in priority, okay? And we did this, I actually went into detail on this in episode 24. So you can check out the detailed work on this in episode 24. But the fact is that at the very base of the wealth priority ladder, we are actually trying to make sure that, one, we get you some liquidity. In other words, that you have the liquidity to sustain yourself during the inflation, in inflationary times, and you get yourself in a situation of debt. Now, there are people who are going to say, well, paying debt back in an inflationary time, you're better off paying it later. Yes, that's an argument that could be made. But I'd rather you be as debt-free as possible, as liquid as possible, to sustain yourself from that perspective first. And so I want you to go through that episode, to go through the details of the wealth priority ladder so you'll know where to prioritize where you put your cash and how you're going to do your investing. And then from that, now we can start to look at what should we be investing in that might protect us against the inflation. So this is going to be all about asset allocation. Okay? And one of the greatest hedges against inflation is, believe it or not, real estate. And we've seen it here. We've seen our real estate prices just go through the roof. And probably where you're at, you've had the same experience, and the prices are going. And how many of you that maybe are in the house buying market, sitting back saying, I got to jump in. I got to jump in. See, that's that fear that if I don't buy today, I can't buy tomorrow because the prices keep going up. Remember, things go in cycles. But real estate, traditionally, in an inflationary time, will increase in value. Now, the challenge with real estate is that you need to have the capital to do it. That's why liquidity is important, so you can get in the game and do that. But having real estate is a great hedge against inflation, which then leads me to another real estate related hedge, and that is real estate investment trusts. A real estate investment trust is basically a mutual fund for real estate. If you, let's say, like there are real estate investment trusts that invest in big office buildings in like downtown LA and Denver and Dallas and everything. There are real estate investment trusts that invest in aged living facilities, in hospitals and things like that. As an individual, you and I, we can't buy that necessarily and own it on our own, but we can buy a sliver of it in a real estate investment trust, and those properties in there will continue to increase in value, or in an inflationary time typically. And that real estate investment trust, when they either sell the properties or they're getting paid their rents, they pay dividends to you, and at some point they'll liquidate the properties or they'll liquidate the real estate investment trust, and you'll get paid out based on value. Typically, it's another possible hedge against the inflation. Now, the other one that can come into play here is what we call inflation protected securities. These are I-bonds or TIPS. They're issued by the Treasury, okay? They've been around for a while, but they weren't something that was readily used too much because the inflation wasn't at the same level and everything. But let's just look at the I-bonds, for instance. The I-bonds, what they do is they have a fixed rate of return. It's a bond. Okay, they have a fixed rate of return, but they have this inflation pop to it. In other words, they will tag it to an index for inflation. So you'll get the fixed rate plus the inflation. And now I think they're going at about 7% in there. But you have to hold it 12 months. And if you and you lose, you'll lose 3 months worth of interest if you cash it out within the first 5 years. Okay, so you got to hold it 12 months. And if you cash it out within the first 5 years, you'll lose 3 months worth of interest. The other thing is there's no secondary market. It's redeemed by the government, and you're limited on what you can get. It's typically $10,000 a year. So this is not something that you can get a lot of, but a lot of people are starting to think about going into I-bonds, or at least start building a ladder of I-bonds. And there's a strategy that you can look at for when you buy them, because their inflation adjustment adjusts at certain times during the year to do that. Then there's something called tips, okay? And tips have a fixed rate, but what they do is based on inflation, they adjust the principal. Now, the nice thing about tips is that there's no limit on it. You don't have that $10,000 limit, and there is a secondary market. So if you wanted to sell it, you could sell it. So these are inflation protected securities that you could look at adding to your portfolio to try and mitigate the impact of inflation. Now, this is not, when you start looking at the wealth priority ladder, this is not where you're going to invest your emergency fund, your peace of mind fund, or those things that you're going to need in the next couple of years. Because remember, your I-bonds have a 3-month penalty. If you cash it out within 5 years, you got to hold it for at least 12 months. We want something for our emergency stuff. We want it completely liquid and doing it from that perspective. And then the other thing that you can think of here is equities. What do I mean by equities? I mean stocks. Think about this. If prices are going up, that usually drives revenues up for the companies that you're investing in the stock market. And when revenues go up, typically profits will go up, so earnings per share go up, which drive the stock price up. So equities are usually a good hedge against inflation just the same. So really where you're looking to put your money is going to be creating an asset allocation. Now let me caveat this. An asset allocation appropriate for your circumstances, for your risk tolerance, for your risk capacity, okay? And your situation, because my situation is completely different than everyone else's. I've got no young kids except that I got a granddaughter. Okay, I'm 60 years old, and you might be 30, and you might have young kids. So it's a totally different game. But I want you to start looking at what your portfolio, asset allocation looks like. How much are you exposed to real estate? How much are you exposed to bonds? How much are you exposed to real estate investment trusts? Do you have any inflation protected types of securities like I-bonds or TIPS? And what kind of equities are you in? And then the last thing to think about here is this. We're in the long-term game. This is really important. We're in the long-term game. That means that the choices and decisions you make with your portfolio, with your assets, need to be with a long-term view. The planning for your finances needs to take into consideration today, your ability to spend and support your living today. This is why I want you to get as out of debt as you possibly can, because if prices go up and you don't have a whole lot of fixed debt, you can sustain yourself much easier. But then I want you to see what it's going to be like for you in the future. So you're going to look at things through the long-term lens of your life as you're starting to plan this. What I'm going to invite you not to do, I'm going to urge you not to, I'm going to implore you not to do, is to get sucked in to the propaganda of the media. Yes, I use the word propaganda with media because understand this. I don't care what station you listen to. I don't care what paper you read. They are in the business of getting eyeballs, subscribers, viewers, readers. And one of the best ways to do that is to juice up the emotions of the subscribers, the readers, the viewers. So don't get sucked into the emotions of what media is doing so they can sell ratings and viewers. All right? Step back and look at it logically. Step back and look at it methodically. Look at what you're doing and investigate it in that way. And if you need help with it, reach out. If you need help with it, reach out to a mentor, the right type of financial advisor. But don't just take what you hear from the screaming pundits on the media and say, oh my God, the sky is falling. Because it's not. We've been through inflation before, and we'll get through it again. We just need to do the right things in the right way and do it unemotionally, do it logically supported by data, and we'll get through it together. All right. I hope this helps. I hope this might settle you down as to what inflation is, what can it do to you, and how can you kind of stem the tide of inflation. And if you have any questions or anything I can do for you to help me out, just send me a note, send me a DM, leave me a comment. Let's see if we can make it happen. All right. I hope that this serves you. And until I see you in the next video, the next episode, always strive to live a life that outlives you. Cheers.